Today is Monday, July 11th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Steve Freed, ADM Vice President of Grain Research, and Alan Bush, ADM Investor Services Senior Financial Economist. Starting with the grain markets this morning, Steve. For 5 weeks, raw material prices have dropped in part due to talk of a global recession. Do you feel like this recent weakness is near an end?
I think so. I think that again, we're trading headline news, but um, managed money really got out of the grains pretty dramatically because of the worry about recession and what it would do for demand. But now, at last week's lows, we're starting to look at some at least 2, maybe 3 weeks of dry weather and warm weather across the Midwest. Some people were hoping in September the dollar might make a top and that the Fed may decide not to increase rates as much as feared. Now, today we're dealing with COVID in China, adding to lockdowns. But I think the markets have made a low for the season. I don't know if we'll go back to where we were, but some people think in the third quarter we'll retest those May highs.
Steve, today's grain prices started sharply higher, but have since backed off. Why the rally and why are we trading off the highs now?
Well, I think that the weather is the number one thing here in the Midwest. We also see some extremely dry and warm weather in Europe. They're already talking about a 10 million ton lower wheat crop there and also a lower corn crop. Argentina politically is a mess. There may not be a lot of exports out of Argentina, and their dry weather could reduce their wheat crop. And we still have the war in Ukraine, which is reducing corn exports out of Ukraine and Black Sea wheat exports. So all these are tightening globally supplies. And as I mentioned earlier, the break had a lot to do with recession headlines and worry, especially about China buying grain. Last week, China came in and started buying U.S. corn, U.S. sorghum, and U.S. white wheat off the P&W, which helped put a bottom in. And I think that the markets right now should continue to firm because of weather.
Finally, Steve, the USDA has a report coming out tomorrow. What will they say, and will it have much impact on prices?
Well, I think usually the July report has very little changes. And I think the key will be the fact that they could actually raise the corn crop maybe 60 to 70 million bushels because of higher acres. And they could lower the bean crop maybe as much as 100 million bushels because of the acreage report. Then I think we will be watching their world wheat stocks number. Even though the average guess is unchanged from June, the spread is about 35 million metric tons between the low and the high. And a lot of that has to do with just what kind of crops we're going to grow this year and what kind of export trade there is in the wheat market. So usually July numbers are not a non-event for the markets, but lately every USDA report has had a volatile price reaction.
Alan, turning toward the financial markets, why are the interest rate markets trading higher in recent weeks if the Fed is likely to hike its Fed funds rate by another 75 basis points on July 27th?
Well, in fact, there's even a small possibility that they could hike by 100 basis points. But the fact that we're seeing futures higher with a more hawkish Fed outlook suggests that the Fed at some of these following meetings, maybe in the September meeting or meetings later, will be less aggressive. And I think that will be the case. So in any event, futures performing well in spite of the hawkish Fed outlook. And I think that in itself should be viewed as a sign of strength. So I'm looking for higher prices across the board in the interest rate market futures.
Portions of the yield curve remain inverted. What does that say about the outlook for the U.S. economy?
Okay, so the inverted yield curve is one of the better indicators of what the economy may do. And that right now is saying that we are going to see slower economic growth. Of course, we did have the first quarter GDP coming in down 1.7%. We're seeing more and more estimates for second quarter GDP to come in possibly negative as well. So back-to-back quarters of negative GDP growth is the textbook definition of recession. And I'm very much a believer that we will see recession in the U.S. economy. And I'm also on board with the probability of negative growth in the second quarter.
Finally, Alan, how about giving us an update on the U.S. dollar and the euro currency? What does that relationship look like?
Okay, so the dollar made new 20-year highs today, while the euro currency made 20-year lows. And the reason for this, especially for the dollar to advance, and especially against not just the euro, but other currencies, is that the Fed is likely to be the most hawkish of all of the major central banks, even though I think that they will be scaling back some of their hawkishness later this year, but so will other central banks. So I'm a believer that the dollar will continue to advance, also believing that the euro currency will continue lower and probably falling under parity, under 1-to-1. So the trends are likely to remain, continue to trade the dollar from the long side and the euro currency from the short side.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.